All right. How much is my business worth? Everyone's going to tell you, this is my answer, what I can find someone who's willing to buy it for. Okay? That's the true definition. In the world of our transaction, what a third-party seller and a third-party buyer agree to is the definition of value. Okay? And the reason I'm telling you that is value is relative. Okay? This is my favorite slide. Okay? Everyone's like, oh, I'm doing 30 million. I'm doing 40 million. I got 50 employees. I don't care. How much money are you making? Right? That's what matters. If you ever want to sell your business in this thing, it's going to be on return on investment. It's going to be on risk. It's going to be how fast can I get my money back? How fast can I pay you because you guys are going to sell or carry it for the most part. It's profit. Don't worry about your revenue. Drive to your profit. Okay. The status of your company and the type of corporation you are does matter for tax purposes. So most of you, I'm guessing, are going to be either a partnership, actually not in construction. You guys are probably all corporations for the most part, and you can either be a C or an S. I would assume that most of you have converted to S's. But the reason I bring this up is if you are a C corporation, okay, you will get double taxed. Okay? And it's really important that you understand that Uncle Sam gets you twice. So you think you got screwed the first round, you get a double screw, as a C Corp if you don't play it smart, okay? So the way the C Corp works is the corporation sells the assets, it takes the profit, it has to pay corporate income tax, it then has money, it distributes it to its shareholders, they pay tax on it. On a sole proprietor partnership or S Corp, the company sells its assets, the tax transfers through to the individual shareholders, it gets taxed once. Of all the slides, that's the main thing I want to get into here. So if you are a C Corp, you just need to be smart, you need to think about it. There doesn't mean there's not a way to get around it, but it's an important element for you guys to be aware. Okay, types of buyers. I was telling you, you identify your buyer, okay? There's basically two types. We call them inside or outside buyers, okay? Outside buyers are generally categorized into three areas, okay? They're generally going to be an independent person like myself. Hey, John, I want to buy your business. I love your thing. Me and my bro want to get into your thing and I want to buy it from you, okay? And I'm a third party, you don't even know me. I just want to buy your business, okay? You have what they call strategic buyers, and strategic buyers are people that are similar either in your industry, so they could be another sheet metal shop, could be another, but it could be a plumber, it could be a GC, right? So it doesn't mean that they're in your vertical, but they are at least in your industry. They call them strategic. Because pretty much what we're going to do is they're going to take your business and plant it into their business, okay? Then you have a financial buyer. And a financial buyer are the guys that are taking other people's money, they're going to buy your business, they're going to fix it all up, and they're going to add a couple more businesses to it, and they're going to package it all up, and they're going to sell it because it's worth more if you're a bigger company, okay? These are what I call the house flippers, okay? Guys that are buying houses, fixing them up, flipping them. Any kind of developer kind of guys, that's what financial guys are. So they're always out there, scum of the earth, swinging on the bottom of the ocean, looking for any kind of fish kind of kicking a little, and then they're going to go up and grab them and go, okay, hey, I got a special deal for you, You either die or I give you something, right? Now, hopefully that doesn't go on the internet because I'll get blamed on that. But my opinion is financial buyers, there is a place for them, but most financial buyers are not interested in construction. Too high risk, too service-based. They generally don't like service-based businesses. Very difficult to scale, because to scale, you got to bring people in. They're looking for, vertical hockey stick type things. But it's important to know that those are your outside buyers, generalized. Inside buyers, most of you, like I, thought that would be an ideal thing. My business is awesome. I'm wonderful. You're going to love my business. Just take it from me. And my guys looked at me and said, I don't want to work that hard. I don't want to work. There's no friggin' way, John, I want your business. Now, I sold in 2005. My logic was, that's a good time to sell. A lot of people were growing. A lot of people wanted. I packaged it up, said, hey, you can grow. The other GCs I was talking to were like, I'm already buried. I don't need more babysitting crap to deal with. I'm good. I ended up selling it to a commercial guy who wanted my custom residential cash flow because he was more of a commercial guy. That was a great idea right until 2008. I didn't get any money, but that's okay. Family, okay? We're going to talk about this a little bit. Family members, transition, key employees. Maybe one of you have said, I have a good guy, I have a good team, I got a couple of people I want to do. That is a way to transition. We should talk about that in further. And then there are partners. You know, hey, there's 3 of us. I'll buy your partnership out. How do you, but you know, you're the one who knows all the contacts, or you're the operations guy. What am I going to do now? So the company, although there's 2 of us, Joe and Robin, or Joe and John are together. And if I go, hey, Joe, I want to get out. And he goes, yeah, but you're really valuable. Well, that's okay. Just cut the wing off the plane and you keep the plane and give me half. You know, it's good. You know, it's all right, bro. Come on. And you can't just cut a plane in half, cut a wing off of it and say it's the same business. So we get into some conversation with partners on the discount for what a partner is valuing, but it is an option for you, okay? But just know, these are very emotional, okay? These are all, outside are all business. They're just looking at your business as a business, okay? Inside, a little different. All right, value. Someone says, what's my business worth? And I'm gonna go to you and I'm gonna say, I think your business is worth 10 million bucks. Sweet, give me 10 million bucks. Oh, but special price. I'll give you $1,000 for 10,000 years for your money. And you're like, well, that sucks. And you're like, yeah, I mean, first of all, you get value. 1 is what do I get paid, and 2 is what I got to pay in taxes. So value is really, really, really important to understand that it's not your sales price. I've got to get you guys out of your heads that what I sold my business matters. What the price you sell your business, completely irrelevant. How much cash you actually receive, because what I sold my company for versus when my buyer went bankrupt and shorted me my money, I felt good one day. I felt like crap. You know, 3 years, actually my wife kind of got for that one, you know, to be honest, but that's all right. Idea is that value is important, okay? But depending on what I can sell it for what a valuation is, what the terms are, and we're going to go through this, and then how much you get in after tax, okay? Here are the key pieces to how we value businesses, okay? We want to know the external. If I'm selling your construction company in 2009, right? External economics of our industry and our world was saying that's probably not a good place to sell, okay? So how the economy is doing, the availability of money, is anybody actually buying, right? How involved the owners are. These items here, this is what matters. This is a key piece. All right, guys. I'm sorry, Gary, what do you see? What do you see in this? There's 2 things there. What do you see? It's just, what do you see? Don't. All right, you need, what do you see, Joe?
Old lady and a leaf on a tree.
Old lady and a leaf on a tree. All right. Anybody see the young lady? Yeah. So raise your hands for young lady. How many see old lady? Yeah? Pretty interesting, huh? So here's the young lady, right? Here's her eyes, here's her nose, here's her ear, right? Fascinating, okay? And the old lady, here's her nose, right? Here's her mouth, here's her hair. Oh, you don't see, so here's her nose, okay? This is her nose, here's her eye, here's her mouth, this is her hair, old lady. Still don't see it. Okay? The reason this is so relevant is that your perspective of your business is not the same way that I see your business, okay? I'm gonna do an easier one for you. How about this? What do you see? What do you see here? What else? And a vase. Do you see the vase? So detail-oriented people are gonna be attracted to the nose and the mouth, and they usually see people. Bigger picture people have a tendency to see the vase because they see it further out when they evaluate the slide. So, you know, you get into trades people, you know, people like that are used to, you know, accountants, everybody out there, very detailed. You get down into the minutiae, the first things you look at is the small stuff. You get into more IT, creative, or just they have a tendency to see the vase first. Pretty fascinating. The point of this is perspective, right? What I see versus what you see in the same thing. When I'm providing a value for your business as a buyer and what you think the value of your business is very different. Okay, and the key piece for you guys to understand is that as a buyer, I do not see it the same way as you do, okay? I care about different things as a buyer. You want cash, I want to avoid risk. You guys want a short payout, I want to extend it over a period of time. You know, I have confidentiality, I gotta get as much information out of everybody I can. I wanna talk to other employees, I wanna talk to everyone I can. Very, very different perspectives here, okay? So it's really important that you guys, when you are thinking about buying your business, at least acknowledge that any buyer is not seeing it the same way you are. Your child is beautiful, I got it. Yeah, your baby is newborn, sure. I don't think newborns are pretty. I think they're kind of ugly, okay? It's just, yeah, sorry, your business is awesome for you. But that doesn't mean that you want $1 million from me that I could go put it in many other avenues to go do, that means I want to go buy your business. You have to get that into your mindset in order to convince me that I'm worth the money, okay? And perspective is key to everything you're doing, all right? Terms. The saying in our world of transaction is, you set the price, I set the terms, right? I want $2 million for my business. All right, I'll give you $200,000 down. You finance $1.8 million over the next 10 years with the profits of the company. I'll buy it from you, right? You say, that's not right. Well, you said price. I gave you the price. You have to give you exactly what you wanted. No, okay, then I want $2 million and I want it all now. Well, now we're different. Now we're playing a different game. So the key is price, terms. What we negotiate, and this is where, if anybody's going to be of any value to you from a transaction type person, we first talk about whether it's going to be a stock or an asset sale, okay? And I'm going to spend a couple of minutes, because I have it, to talk about the difference between a stock and an asset. A stock sale, okay? A stock sale means that I am personally, John Overham, is buying your stock from you as an individual. The company still goes. It would be like you buying Apple stock, you buying Tesla stock. The company just keeps them. They don't know who's buying selling stock. It doesn't matter. You do it on the public exchange, you do it on the pink sheeted stuff, or you do it individually. It's just selling stock, okay? The liabilities transfer over to me. The FEIN number stays. Nothing changes. All it did was just stock, okay? If you sell an asset of the company, okay? An asset of the company means that what you're doing is, my company, you're only going to pick certain pieces out of it, and you're going to roll that into your company and usually form a new corporation. So you're going to take my goodwill, my name, my people, my computers, my desks, all my inventory, all my trucks, all my tools, but all the liability stays with you. So if you ever get a workers' comp claim or a payroll claim after we leave, or a construction claim, your company has it. I didn't buy that from you. I didn't buy your stock. I only bought your physical assets, okay? So most transactions are asset-based, as you could imagine, right? So I'm gonna go in, I'm gonna buy your business, but I only wanna buy these items, okay? And then I'm gonna take them, I'm gonna open up a new company. So I am John Overham Sheet, I'm Overham Sheet Metal, and I'm gonna sell you Overham Sheet Metal's assets. They're gonna open up a new company called Overham Sheet Metal Inc. And they form a new corporation. We take those assets out and we move them into here. Now all of the liabilities stay with you as the seller, okay? So typically what you do is then you have to keep the receivables and payables. You gotta pay those off. You gotta do your final workers' comp audit, your final general liability audit. You gotta do other stuff, because the company still exists. It's just a shell. Right? You no longer have your name, you no longer have goodwill, you no longer have a phone number, you don't have no phones, but the corporation from the federal and the state still exists, okay? So an asset purchase is what most people do for the betterment of protecting liability. But there are many reasons why we will do a stock. So with a lot of the government contract work, because I'm in San Diego, we have a lot of government work down here. So if you have government contracts with SAIC, that takes a while to get. So you can't just take that off. We got to sell the stock. There are reasons for contracts in place that selling stock is better, okay? But it's a negotiated point. That if I take the risk, I'm going to pay you less for it. Right? Makes sense, right? There's going to be some kind of indemnity that I'm going to require you to sign. You might have to get insurance. That if I get sued in the next 5 years because something you guys did when you owned it, even though I own it now, you're going to pay for it. So I'm not going to give you all your money right now. I'm going to stick $1 million over here into this fund, or you're going to go get insurance for it. So if there's a claim, you have to pay for it. We call it an indemnity clause, or what they call a clawback in our term. It's called a clawback. And why that matters is if you sell the stock or an asset, that changes value, okay? Obviously the sales price, it is important. Usually people in construction they're taking it off of net income, or what we're going to refer to as Ebitda. And we're going to go after that term. And the reason why is that selling your revenue is not really important in your industry because your margins are so variable from job to job and everything else. That was a polite way of saying your margins suck, but I just had to be honest with you, okay? In the world of selling businesses, your margins can go in. So pretty much everyone is looking at a service-based construction company with what we refer to as a discounted cash flow. How much money do I put in now, and how fast will I get it back? Okay, and how long that would take. So let's say your company's worth $1 million, and you're making $250,000. It's going to take me 4 years to get that back, right? So that's a 4-year return. Well, technically, that's a 25% rate of return, right? Because I invested on 100,000, I got 25 in, I got it back. So 20. That's pretty good. In our world, they're looking for 30 to 40% in your industry. So your multipliers are right around 2 to 3 time multiplier of your what they call Ebitda, and we'll talk about that. But the reason why that's relevant is we're all about profit in your industry, and we're all about return on investment and what's the risk associated with that, okay? Once again, the next big step is financing. I'll set the price, how much you're gonna finance, how much you're gonna be down, and how much you're gonna finance. And then if you're gonna finance it, what's the security? I had security against the guy's house. I thought I was sweet. I had it against the business and I had it in the house. My lawyer said, well, John, you know, you might never see that. And I'm like, you don't know what you're talking about. You know, I'm 40, I know. I'm a business owner, I know. I got screwed, right? I was fourth, right? He had his first, he had second line of credit, he had the SBA to buy me, and then I was in the fourth position. Well, yeah, I saw nothing, okay? And in the business I got back, he had completely imploded. You know, if anybody wanted a general contractor's company that imploded in 2009, I got one for you, okay? Mine was not a sweet deal. So financing, really important, okay? The more that you finance, the higher the value, okay? Because if you're gonna run the risk, I had a client who said, I'm gonna sell this business to my key employee for $1 million. He's gonna pay me $100,000 a year over the next 10 years. Said, okay, do you want my opinion of value? He said, no. You want my opinion of the terms? He said, no, we're doing this because this is my way of helping him out. I said, well, have you talked to your wife? You might want to talk to your wife about this before you go walk out of here and say, I promise, honey, in the next 10 years, we're going to get a $100,000 check from this key employee and we can go play around, right? We need to put some securities into this. In his world, he was comfortable with it, okay? He set the terms, he set the price. I wouldn't have been able to give him any logic otherwise. It was between the two guys. So then I helped him facilitate the best way to do the transaction. What happens to get life insurance? What kind of security? You know, what if he doesn't make payments? We secured it against the stock of the company so we could get ownership back fairly quickly. There's ways to mitigate risk. But the whole point is the financing arm to your transaction is relevant to the value of your business, okay? This term called earnout, and I know I'm fire hosing at you guys. There's a lot to do here. I could spend the 2 hours just on one of these things, but I want to give you the big picture, okay? Earnout. An earnout would be typically you say your business is doing $10 million in revenue, okay? And based on that, you've made $1 million net profit or EBITDA in my terms, okay? Great. And I'm projecting next year I'm going to do my 10%. I'm going to do my 10% because you guys are so conservative that that's just what you do, right? And then we sit around and say, okay, great. We're going to give you a value based on that $1 million, but that's assuming that you're going to continue to climb. So here's the deal. I'll pay you flat. So I'll pay you 10 million. I'm not going to pay you on the come, what's going to come up. But if we hit these numbers and you stay on and you work with me, I'll give you a percentage of this extra money that we're making. So we're going to agree on a sales price of where you are today. You just got a new client, you just got a new product, you just got a new machine, you just got a new job, you're saying that it's going to be worth more in the future. A buyer will say, fine, we'll throw it into what we call an earnout bucket. I'll pay you for what I know because they're buying your past, and we're going to partner in the future, which is called an earnout, okay? Just know the term. We can go into it further deeper. Non-competes, pretty standard in the state of California, really hard to enforce. The state of California, as owners, you understand it is an employee-based state. So they really don't want you not to be able to get a job if you want a job. So there are constraints around it. They do exist, but they're pretty tight, and they're usually region-based, and they're hard to enforce. So just be aware of that. The continuation agreement, many times, because you're service-based, they're going to want you to stay on. Hey, would you stay in and keep doing your job and everything else? I will tell you, doing that, it sucked. It was really hard. It was like, I've got it on screen, but I'm going to do it anyways. It was like living with my ex-wife who just got remarried. It's like, really? I mean, it was just a horrible, this guy was screwing up this company so freaking bad. He had no idea, and I had to go in every day and just watch him and go, oh, dude, that is just horrible. It was horrible. But he owned the company, right? He's like, I know, I'll make all these changes. I'm going to improve it. It's going to be better. And I'm like, oh, really? Do you want to ask me? I mean, I've been doing it for 15 years. I know this. No, I got it. And I'm like, oh, wow. So be careful. What I always tell everybody, if you do have an earn, if you do have your continuation, 6 months, don't go more than a year. 6 months, you're going to be, you suck at employees, being an employee. I'm just telling you, you're not a good employee, okay? You're not going to be a better employee of a boss who just bought your company and is now telling everyone what to do. You just suck at it. So don't pretend like, oh, honey, I'm just going to keep a job and I'm going to get 200 grand. I'm just going to show up 20 hours a week. And it just doesn't happen, okay? So just be aware of it. It exists. It's part of the deal. Usually it's engaged as part of the sales price that you get a couple months. Like, I'll negotiate maybe 2 months, 3 months, but I'm like, you don't want my honor. You don't want my honor. He'll be there, he'll help you, he can come in when he needs you. Usually what we do is we set it up as a consulting agreement as an outside, because then we can run through tax benefits associated with that. The big tax strategy, and I'm gonna talk about that real quick, is when I buy your business, Gary, okay, I'm gonna buy your business. I'm going to buy it for $1 million. I'm going to give you $500,000 for your business, and then I'm going to pay you $100,000, $200,000 a year for the next 2.5 years in this continuation agreement. You don't have to show up. Okay? So the strategy to that, and the reason why I would want to structure that deal is the purchase price for the 500, I have to use after-tax dollars to buy. So if I took a loan out, I got to take my income, whatever profit, tax on it, then I go pay my bank. So I got to make $1 million to pay $500,000 of that. But if it's in a continuation agreement, I get to expense it because you're technically an expense. So it's a dollar for dollar deal for me as a buy. Now for you, the reason why that works is that if I give you $1 million, you're taxed at highest tax bracket. But if I spread it out over for a few years and I give it to you in a consulting agreement, then you can write through some expenses over the next couple of years, your car, your cell phones, medical travel, and you can do whatever you do with your own moral compass on how you can then bring that down to a taxable value. So both teams win, okay? So this is a strategy the IRS figured out that we were doing, okay? So we do it, but you have to be clear. You can't just go, here's $1 for your business, Joe, and I'm going to pay you $10 million for the next, $1 million a year for the next things, and that's for working for us. Okay, it has to be reasonable. You're supposed to show up. You're actually supposed to do something. But
Do something for 10 minutes.
yeah, I mean, you haven't done anything anyways now, so why does it matter, right? He said, Gary's like, I don't even work right now, so why, what the hell? But it is a way to negotiate, and it's important. And the reason why that matters is someone says, what was my sales price? Well, he sold his business for 500 grand, or did he sell it for $1 million? I don't know. Depends. Did he get all 500 as a continuation? The guy screwed up when he was gone. So valuation matters. This is the key number for you guys. This is a term that you need to be aware of. It's called Ebitda, okay? This is what nerd accountants, investment bankers, finance people call it, okay? It is earnings before interest, depreciation, interest, taxes, depreciation, and amortization, okay? The reason that they do this is that we're kind of basically saying depreciation is a non-tax and non-cash item, so we want to put that back in, okay? And then the interest, I'm not going to have interest because I'm paying cash, so I shouldn't have to do so. Amortization is also tax write-offs. Then we add a few more things to it. There are all these things called one-time expenses, okay? Because we want to normalize your financials. One-time expenses would be, hey, I had a big lawsuit and I either won or I lost. I got some money. I sold a big piece of equipment. I bought a big piece of equipment, okay? Made your income that year bad. So we take all those what we call one-time expenses out to normalize it, okay? And then we have this thing called owner's add-backs. I know none of you do, but I did, so I'm just going to say I'm the one who runs a bunch of personal expenses through his business, okay? Never. I know, you guys, you're different. You're different. Construction guys, never. Nah. So let's just assume other people around you, not you, do this. And what we do is we pay for our family, friends, our trips, our cars, our travel, whatever we want, whatever we can that we, in our own moral compass, feel is reasonable, okay? Well, we all know when we're selling a business that those exist. So what we do is we call those add backs. They're owner add backs, because we've got to put those back in. Sometimes you pay your children through the business. Sometimes you're compensated at a higher rate than you're really worth, in my world, of replacement value. Not worth in your world, but there's replacement value, right? So sometimes people are putting other family members on it so they can put them in the 401k. There's all the different strategies. I've seen it all. It's all fine. The reality is we add that back in. So now you take your net profit, you add back interest, taxes, depreciation, you add back any one time, and we add back your owners. And that becomes your term Ebitda, okay? Because in one situation, I had a husband-wife that I'm selling right now, and the husband and wife together are making 500 grand. So I can replace, I really only need one of them. So I added 500 and then I put 200 grand to replace them because I did need a CEO. So I added $300,000 back to their net profit because that's in excess of what it would really cost me if I owned your company, okay? So the term Ebitda is what we use because this is the return on investment, okay? Know that number, it's a geek number, but it's the way that everyone talks in the transaction world. All right. So can I sell my business? I'm telling you, yes, depends. What's your definition of sell and who you're selling it to and what the win is. For me, I just need to know what's the win, okay? 2 is, what can I get for it? That's the value, okay? Generally, I was telling you the Ebitda, most people in our industry are 2 to 3 times Ebitda, okay? So if you said, hey, John, how much is my business worth? And I came to your place, I would generally tell you it's a 2 to 3 times your Ebitda number. It's not gross revenues. Some people go, it's 1 times revenue or it's 0.5 times. No, not in your industry, okay? You're a tech firm. Yeah, we're all about revenue because it's not about profit if you're a tech. Crap, look at the freaking stock market if we actually did it off net profit for the tech companies. It's all off of growth, right? So depending on your industry, our industry, 2 to 3 times. What that means is people are looking between 30 to 50% rate of return on their money, right? Because it's going to take them 2 years to pay it back or 3 years to pay it back. So the other key thing in your value is the higher revenue you make and the more profits you make, the easier I can sell your business, okay? You guys are doing $100 million in revenue, making 10, I can sell your business, absolutely. You're doing $10 million of revenue and you're making $1 million, yeah. You're doing $1 million worth of revenue and you're making 100 grand, you might want to look for a friend, okay? And it's the same business, it's the same structure, it's the same industry, it's the same everything. More money, the better it is. And the main reason why, and this is what the buyers are telling me, is that it takes a lot of work to take over a business. But if I only have $1 million worth of what we call Ebitda, then one mistake could really crush it. If I got $10 million worth of money, then one mistake won't crush me. I have more wiggle. So it's basically more lemons, more lemonade, right? That's kind of the philosophy of what we're going for, okay? So revenue matters, profit matters more because they're looking for how much room do I have. And a bank that's going to finance you wants to know how much room you have, right? So how much you have to spend, your Ebitda is your key piece, okay? I'm not telling you,
Size does matter.
Size does matter. Yes. I need that on my slide, huh? What kind of photo should I put with that? Never mind, we're moving right along.